Imagine waking up on February 1st, 2026, scrolling the markets and feeling like you just walked into a financial battlefield. Bitcoin, Ethereum, XRP, the pillars of crypto, are all under pressure, shaking fear and opportunity into every corner of this market. This isn't just volatility. This is a pivotal moment that every trader, investor, and blockchain believer needs to understand. Let's break down what's happening right now, with real market moves, key trends, and where this narrative could go next. Bitcoin, the king of crypto, has pulled back sharply. After flirting with higher levels just weeks ago, BTC prices tumbled, with markets dipping below $78,000, $80,000 amid heavy selling pressure, a level that hasn't been this contested in months. This drop has wiped out hundreds of billions of dollars from the total crypto market cap in just a short span of time, signaling that bears aren't just whispering, they're roaring. This isn't a random blip. Multiple analysts have pointed out that Bitcoin may be finding a temporary bottom near this zone, but sentiment is cautious. Some see support forming, while others warn that macro forces, like shifts in central banking policies and global economic unease, are weighing heavily on risk assets like Bitcoin. For many traders, this is a test of how deep the bull market conviction runs. Ether, the backbone of smart contracts and decentralized finance, hasn't escaped the storm either. ETH prices have slid significantly, going as low as around $2,400 during sharp liquidation events. That's a major move down from earlier highs, and it reflects how quickly extended positions can unwind when the market turns. But here's the twist. Unlike some previous downtrends that completely eroded confidence, there's evidence that institutional demand hasn't vanished. Ethereum remains foundational in the blockchain ecosystem, with developers and institutions still building on it. Staking, decentralized applications, dApps, and NFTs continue to draw real utility, all of which create a deeper floor under the price than speculation alone could achieve. Then there's XRP. Ripple's token has been one of the most talked about assets in this correction phase, not just because of price moves, but because of how it's positioning itself amidst regulatory developments and institutional interest. XRP is trading in a range that many see as consolidation before a breakout, with analysts placing its potential price targets both above and below current levels depending on liquidity and market strength. Across the board, the fear and greed indexes are showing that fear still dominates sentiment. Investors are second-guessing entries, and long-term holders are showing stubborn resolve not to capitulate. This has created sharp bounces followed by swift sell-offs, a hallmark of a market that's trying to find clarity in chaos. So what's driving all of this? Price action doesn't happen in a vacuum. One enormous underlying factor now taking center stage is the looming threat of quantum computing. We're not talking hypothetical theoretical musings. Top blockchain developers and foundational figures like Ethereum co-founder Vitalik Buterin have publicly warned that advanced quantum computers could eventually compromise current cryptographic defenses. That includes the elliptic curve signatures that secure Bitcoin and Ethereum wallets, the very algorithms that underpin blockchain security. Make no mistake, quantum computing promises computational power far beyond today's machines. Shor's algorithm and other quantum breakthroughs could, in theory, break widely used cryptographic methods long before 2030, if no defensive upgrades are made. It's a debate that's igniting entire teams within the crypto community to start building post-quantum resistance into protocols, signaling a generational shift in how blockchains secure value. This looming transition isn't just a sci-fi subplot, it's already shaping investment strategy. Projects focused on quantum-safe signatures and cryptographic upgrades are now commanding attention that they never had before. The market is beginning to price in the future security narrative, not just immediate adoption trends. Now consider this broader context. The broader cryptocurrency market isn't acting like a herd on autopilot. There's institutional capital interplay happening behind the scenes. In recent months, U.S. crypto ETFs saw significant flows, with hundreds of millions of dollars moving in and out of spot Bitcoin and Ethereum funds. These capital flows often act like a tide, lifting all boats when positive, dragging them down when negative. In January, inflows helped reverse a prior streak of outflows, showing that institutions haven't given up on crypto long-term. They're just pricing risk differently now. These inflows matter because institutional behavior often signals where the market could be headed next, especially once retail traders start to follow their lead. When big funds allocate capital, it's rarely for short-term swings. They're looking at years, not hours. And that suggests to some analysts that crypto's fundamental narrative hasn't died. It's evolving. Speaking of evolution, there's another important piece of context. While Bitcoin and Ethereum struggle for footing, the broader crypto landscape is still innovating. Projects across DeFi, Layer 2 scaling, interoperability, and real-world assets continue building. Solana's throughput, decentralized Oracle networks like Chainlink, and institutional settlement rails for stablecoins are all expanding the market's fundamental use cases. Though prices might be down, utility adoption hasn't stalled. This is critical because price goes up and down, but utility builds the network effect that underlies long-term value. Fear and uncertainty still dominate sentiment right now. Forums and trading communities are full of conflicting views, some predicting relief rallies, others calling for deeper plunges. But one thing is certain: volatility itself is the market's new normal. Whether Bitcoin breaks below recent lows or rebounds above psychological resistance levels, every move now is being watched, analyzed, and judged against both legacy financial markets and macroeconomic signals like interest rate shifts, geopolitical tensions, and digital asset regulations. And that brings us to perhaps the most crucial realization. This isn't just a correction, it's a recalibration. Crypto is no longer a fringe asset class reacting only to speculative mania. It's now deeply intertwined with traditional finance, emerging technologies like AI and quantum computing, and global regulatory trends. For investors and traders, that means risk management isn't optional, it's foundational. You can't treat crypto like a casino anymore. The stakes are too high, the capital flows too significant, and the technology too entrenched to ignore. People are now evaluating crypto through multiple lenses: security, regulation, institutional behavior, macro correlations, computational threats, and real-world adoption. So what do you do right now in a market like this? First, stay informed, not emotional. Price moves like we're seeing now create loud noise, but successful participation requires discipline and clarity. Use real data, understand the narrative forces at play. Don't chase the hype or panic into fear. The market's psychology today could be tomorrow's historical turning point. Second, diversify your understanding. Price performance is only one dimension. Look at network activity, developer engagement, institutional interest, and real adoption metrics, because these fundamentals evolve slower than fear-driven price swings. Third, prepare for the long arc of technology, not just short-term price moves. Blockchain networks are still being built out. Quantum resistance, new consensus mechanisms, scalable smart contract platforms. These innovations are ongoing. Those who invest only based on short-term charts without regards to long-term technological shifts often find themselves outpaced by broader industry transformation. Finally, remember that every major trend you see today has speakers, doubters, believers, and skeptics. And that's exactly what a maturing industry looks like. These volatile chapters don't signal the end. They signal evolution. Today's market turmoil might look chaotic on the surface, but beneath it lies one of the most profound financial experiments of the 21st century. A decentralized financial system that learns, adapts, and persists through uncertainty. And if you're paying attention, not afraid of complexity, you're part of that next chapter. Because when markets speak loudest, opportunity often whispers the clearest.